We're so honored to have Jason Jessup, the CEO and Director of Magna Mining, and Paul Fowler, the Senior VP, joining us this morning to tell us all about their first production in March and the check in the mail. Please.
Yeah, thanks a lot, John. And yeah, it's great to be back on here talking to you. We had, I think, some big aspirations when we first spoke about where we wanted to take our company and to become a producer and acquire non-core assets in the Sudbury Basin and advance our existing projects here in the basin. And we've accomplished a lot in the last 12 months. It's been quite a wild ride, actually. So I'm going to jump right into it. So throughout this presentation, I just want to caution the listeners, there will be a number of forward-looking statements. So as we talked about before, John, we've really built our company around sort of three pillars of growth. The first one for being production and being able to move into production in Sudbury, low capital costs. Second is through exploration and discovery. And as you probably recall, a lot of our team are the former FNX team, and FNX here in Sudbury made a number of significant discoveries, and we are excited about the exploration potential we have. And then the third pillar of growth, and this is the one I think that, over the last 2 or 3 years has really been the driver behind our company, is the synergistic acquisition of non-core assets in the Sudbury Basin. So we acquired our Crean Hill mine back in 2022. We closed the acquisition of 8 properties from KGHM in February of this year, so very recently. And that has really driven the growth of our company and made us a producer. But we're not done with our M&A activity in Sudbury here. We see a lot of other opportunities that fit very well with Magna and our team. So this will continue to be a pillar of growth for our company. So this is the map of Sudbury showing our different projects. The McCreaty West mine in black is our producing mine. McCreaty West, and I'll talk a little more about it, but it's a mine I know very well. I was part of the FNX team. I ran the operations at the McCreaty West, and then subsequently the Levack mine, which is next door. McCreaty West has been producing since FNX reopened it in 2003. So a long track record of replacing resources and reserves year after year, and it really is a great little mine. We're thrilled to own it. And then in blue are other 4 permitted projects in Sudbury, and that's the Levack mine, which is on care and maintenance since 2019, the Podolsky mine, which has been on care and maintenance since 2014, the Crean Hill mine, which we took a bulk sample from surface last year, but is permitted to go underground with a ramp and start production there, and then a Shakespeare mine, which is a feasibility stage permitted project with permits to build a 4,500 ton per day open pit mine mill and tailing storage facility. And then in gray are the exploration properties we currently own. We are also planning on closing another acquisition of a portfolio of exploration properties in and around Sudbury later this month that we announced that we'll be acquiring from NorthX. So it's a great portfolio of properties and projects with a producing mine. And the great thing about Sudbury is the mills are looking for feed. So both Valley's Clarabelle Mill and Glencore's Strathcona Mill, both looking for additional feed. We have agreements with both these mills to provide and sell ore to them. As well, there's 2 smelters locally, one owned by Valley, one owned by Glencore. So very strategic infrastructure, city of 180,000 people, very much embracing and depending on mining for their economy. So great place to do business, easy to move mines ahead, easy to find workers to operate them. We couldn't be more pleased, and this is why we are in Sudbury. So as you've probably seen from that map, John, there's a lot going on for us in Sudbury. but we are very much focused. And so our McCreaty West mine that is producing, that is really what we see as key to our plan. And by getting McCreaty West to the point where we think it's sort of running at an optimal level, it has, the right amount of development in front of it, along with the right amount of production drilling drilled off in inventory to have a consistent production profile that's running at what we believe optimal. And at this point, we're still figuring out what that right level is. Historically, the mine in 2023 produced 317,000 tons at about 1.6% copper with some nickel and precious metals. We think that it can produce much more than that. Back when I was running the operations at McCreaty West in 2008, we produced about 720,000 tons from our 700 zone, our intermain nickel, as well as our PM zone in the footwall. So we think that there's definitely the capacity to move more rock. There's a significant resource still, so we will continue to advance McCreaty West and get it to the point where potentially it could provide the organic cash flow to then start reopening and developing our Levack, Crane Hill, Podolsky, and Shakespeare mines. So McCreaty West as the potential cash flow generator to restart and develop our other pipeline of projects that are already permitted. So it is, I think, a very practical, in this market, a very practical approach and a bootstrapped production plan. And again, with very significant resources to support that and permits in a great jurisdiction. So our focus, as I said, on McCreaty West is a number of things we're trying to do at McCreaty West that will improve, we think, the production profile with a potential to increase the copper grades there that we will be producing. And again, these are very much targets right now, but as I said, currently producing, historically from KGHM about 300,000 tons of ore per year. We think we can increase that potentially to 400,000 by the end of this year and potentially more beyond that. There's some opportunity for sure. And then our other focus for this year will be on Levack Mine and the exploration and a potential restart plan that could be initiated as early as 2026 to restart that mine, which would be our second operation. And then as we're doing all of this, we have our exploration team also evaluating all of our exploration properties and our targets to prioritize those so that we can start drill testing those in the second half of the year outside of Levack and McCreedy where the drills are currently turning. So this is an aerial photo of McCreaty West mine. It is a very simple mine. And when I say simple, like I've been at a number of mines over my career, I've never worked at any that is as simple an operation as McCreaty West. It is largely ATCO trailers on site, very few permanent structures, and it's been operating like this for 23 years. It does have a portal, so there's no shaft. It's a shallow mine, ramp access, and simply we develop, drill, blast, muck the ore, load it into trucks, haulage trucks come up to surface, dump the ore on surface, it goes through a crusher, then through a sample tower that takes a representative sample. That gets, shipped off to either Valley's Clarabelle Mill or Glencore's Strathcona Mill, and then we get paid for it afterwards. So very simple operation, nice compact site, and located right on the rim of the Sudbury Basin. So the things we've really worked on since we acquired McCreaty West on February 28th of this year, which has only been, what are we into, 10 weeks right now. So it's very new, but the things we really focused on is we brought in some new site leadership that are, I'd say, skilled in initiating changes and improving operations. There had been, I think, a lack of focus on McCreaty West by the previous owner just due to the size of that company and, not being a core asset. We've added in a fourth shift schedule. So previously there was only 3 shifts operating, which meant 12 shifts per week. We're at 14 shifts per week now, so we get that extra coverage, which is great. And we've also given a lot more ownership back to the mine to manage it themselves. So the mine manager has a lot more authority and accountability now than was previously given by the previous owners. We've also recognized, and we knew this long before we acquired it, that the equipment was old and tired. So we're in the process of replacing some of the prime movers. We had our first new scoop tram coming onto site a few weeks ago, and over the next 2 years, we'll be looking at replacing a lot of those prime movers, sort of, one piece at a time, to just again provide that sort of stability and investment to make this a long-term sustainable operation. The other thing that we saw missing was a lack of capital development and operating development as well, just to get out to new workplaces. So that has been a major focus, and we've had great success increasing the development rates, just getting the team really focused on it, adding in that extra shift, making sure they got the equipment they need. And that is going to allow us to access new areas of the mine that are on the, sort of the western side of the deposit that previously have not been mined in the last 23 years. And we think that's a great opportunity. And as well, just a lot of business optimization, bringing in some new software, getting a lot of the processes streamlined. So taking a lot of the administrative stuff away and replacing that with some technology, freeing up our people to do more work that we think is more value added. So I'll get into some verify slides right now to kind of highlight the operations a bit. So this is the property boundary of McCreaty West, and then right next to it, Levack Mine. The McCreaty West mine site is sitting right here. Levack's right over here. And the town of Levack sits right beside it. So the McCreaty West mine, as I said, is a ramp access mine. It has 3 distinctly different zones. So it has the intermain contact nickel zone. It has the PM footwall copper PGM zone, a lower sulfide, higher PGM area, and then the 700 footwall copper zone. And that is where our focus has been and will continue to be for this year. That's where we see the biggest opportunity and the best margins in this price environment. Currently, there is a significant NI 43-101 resource on the McCreaty West mine, about 9.3 million tons, and that's a combination of all 3 of these zones. And as you can see from this image, the contact of what they call the Sudbury igneous contact runs down like this. And that was part of the formation of the Sudbury Basin, the meteorite impact. That would be the edge of that crater. And this is where the nickel deposits would sit. So you can see very distinctly different. And then coming off of this back into the footwall, we have the 700 footwall zone. And this is much more copper rich. And then off the bottom of that is the PM zone. So that does allow us to very much focus by commodity at this mine and give us that optionality that when the timing is right, we can get back into nickel mining very quickly because the development's already in place. These drifts are all accessible. So to get back into nickel mining can be done very quickly. And KGHM had dabbled in nickel mining, and a few of the stopes that were already drilled off when we acquired it were blasted. So we will be shipping a little bit of nickel ore, but really our focus is going to be all on the 700 footwall copper zone. So as you can see here, in that 700 footwall zone, there's about 5.2 million tons of 0.7 nickel, 1.92 copper with some precious metal byproducts. So it is the bulk of the current resource. And again, this is where our focus is. There is really, I think, some good potential here to mine higher grade than the historical sort of 1.4 to 1.6% copper that KGHM was mining And it just takes a little bit more focus and a little bit more grade control. That is something that a lot of our team, who were part of the former FNX team that were operating McCreaty West Mine, did very well. And now we mined in the 700 complex with different mining methods, more selective mining methods, but we're consistently producing 4 to 5% copper at lower tonnages. We think there's definitely an opportunity to still use long hole mining methods, but again, using better geological information and stope design to potentially increase some of those grades over what they have been historically over the last few years. So this image right here is showing in green our planned development for the rest of this year, and then conceptually for next year. As I mentioned earlier, and these yellow shapes are planned stopes for this year. So the Inco, when they were mining this, they mined this portion of the main ore body and the 700 complex. Their focus was really on nickel. They were, Inco, the international nickel company, focused on nickel. They'll mine the copper if it is associated with the nickel, but they weren't at the time they were mining McCreaty West Mine in the 70s, 80s, and 90s, really too focused on copper. So as you get further into the footwall, you would have more copper, and that's really what the 700 complex was. And so once you got further to the west and further underneath this deposit, the nickel really starts to drop off, and a lot of that was left behind. And this is what we had been mining now for FNX for a long time. Now, a lot of the access to this western side had been cut off by stopes that had been mined and backfilled. So this development is really to get out onto the western side of the 700 complex into areas that were never mined by Inco. And there is, we think, tremendous potential to come in. And this is sort of the next, call it 18 months of development and setting us up for longer term production. But this development can continue at depth, probably for at least another 300 feet at depth and horizontally, almost right around this entire western side of the deposit. So opening up a lot of ground that hasn't been well drilled off, but definitely shows very good potential. And we'll be getting into some of this material sometime later this year, probably in the fourth quarter. So what might that look like? So some of these are drill holes that we've released over the last couple months since we acquired the property. And some of this is being used now to update stope designs and plan out new stopes, but it does show some very good potential for higher grade copper. As you can see in some of these holes that are right in close proximity to stopes that were designed, some of these were designed prior to Magna taking over the mine, and they were in this plan for this year, but in our opinion didn't have enough drilling. So we're doing that work right now. And as you can see, 6.8% copper, 0.2 nickel, 7 grams over 11 meters, including some much higher grade intervals, 14% copper, 3.5 nickel, 6 grams over 9.6 meters, almost 12% copper, 21 grams over 8.2 meters. Very, very good stuff. And we are quite excited to be developing and getting access to some of these areas. If we look at some of the older holes that kind of informed us of the potential, these holes that are numbered are old Inco holes, but that were drilled further out onto the west side of the 700 complex. And again, some of these have some pretty good nickel in them, but are much, much more copper dominated. And we think that, especially up in this 930 area, that FNX and KGHM had drilled over the last number of years, but didn't necessarily invest the capital to get out and start stoping some of these areas, shows some really good potential, again, for some high grades over good widths, and some of them do have some high nickel byproduct or contributor to the revenue. So these are some of the areas we will be mining, over the next 6 to 9 months up in this 930 area. So that's McCreaty West, which is, again, that is our cash revenue generating mining operation. Right next door to it, we have our Levack mine, and I ran the operation at Levack mine from 2009 to 2011 under FNX and Quadra FNX. A great mine. It was a historic mine that operated for over 100 years. It has produced over 60 million tons of ore out of this mine, with that all coming from underground. It is still, we think, a fabulous deposit, but it needs some investment again. But as you can see from this picture, it has a lot of, the infrastructure you want to have. Great office building that we're using right now for a lot of our team. It has its number 2 shaft that's operating with full hoist room. It has sample tower, a backfill plant. A location where we're currently looking at is a potential new portal and ramp to access some of the near surface mineralization that we're drilling. So it is a great opportunity and a great part of the Sudbury Basin with a long history of mining. So as you can see, again, McCreaty West right here, Levack mine we were just looking at right there. So McCreedy and Levack are connected underground with a drift. So Levack mine is the secondary egress for the McCreaty West mine. In case of an emergency, they couldn't go up the ramp, they can come across Levack and go up the shaft. So the shaft is still in operation. It's also used, this drift right here goes across to Glencore's Onaping Depth project. And Levack mine is also secondary egress for that project. And once it's in production, that operation. In red, again, we have our contact mineralization, like we have at McCreaty West. So at Levack mine, it came down. There's a couple places where it blows out into the footwall, but overall, the trend is something like this. And then in the footwall, we have our footwall deposits, namely the Morrison deposit, which was discovered by FNX and then put into production. And I had the pleasure of managing that operation when we were mining the Morrison deposit. Very high grade, consistently producing, while I was there, 8 to 10% copper month after month, with 1 to 1.5% nickel and 8 to 10 grams of precious metals. So super valuable ore. Now the resource here at Levack currently is a historic resource, so this is not NI 43-101 compliant. We are working on updating this by the end of Q3 and have a compliant resource, and that'll incorporate some of the drilling that we're doing currently. But still a fairly significant amount of contact mineralization between indicated and inferred of about over 5 million tons at about 2% nickel, 1% copper, and a considerable amount of footwall mineralization as well. So the Morrison deposit was mined up until 2019. It is, like as I said, currently on care and maintenance. It has ramp access down to about the 5,000 foot level, but there's still a number of veins and zones that were not mined for a number of reasons. The resource currently sits at a historic resource, again, at about 720,000 tons at about 4% copper, about 1% nickel, and about 5 grams of PGMs. We see a lot of potential in the Morrison deposit as we continue to understand what's controlling it. And, I'm fairly confident that we will be able to incorporate it into a restart plan. We'll be able to mine some high-grade copper once again from this deposit. Now, over the last couple months since we closed the acquisition, we've been doing some drilling near surface, and this is to support that restart plan of Levack that we're working on. One of the areas we're really interested in is this area called the Keel Zone, and the Keel Zone sort of sits right in this area here. We've drilled a few holes trying to better define and understand the orientation of these high-grade copper veins, but much like the Morrison deposit, these veins can be extremely high-grade, sharp wall type veins, where we've seen, intersections, 24% copper, and historically in some parts of the Keel Zone, up to 30% copper, over relatively small widths, but still, sort of 1 to 3 meter wide typical widths, which are very amenable to mining, as we've done in the Morrison deposit. And again, even with dilution in the Morrison, we consistently produced 8 to 10% copper that was coming up the shaft and out of the mine. One of the things we are looking at, because this is relatively close to surface, we could access this through a ramp, which might be very advantageous because a lot of the upper levels at Levack Mine were mined in the 20s and 30s and 40s. Track drift, so small drifts, not very conducive to modern mining methods. Having a ramp gives a lot more flexibility and an ability to move equipment around, and we think that it could be a very good option for a restart. As well, we're drilling some holes in and around what's known as the main ore body, which is partially this bulb that sticks back into the footwall. And again, we think there's opportunity to follow up and drill out on that, looking at some nickel and some copper areas that either were unknown to Inco or just not their focus at the time, because they had such a large, massive deposit here where they were mining consistently 2.5% nickel, 2% copper, and a few grams of PGMs for many, many decades. So they had a pretty high threshold for what their cutoff was at that time. So our exploration team, led by Dave King, was part of the original FNX team that discovered the Morrison deposit, along with Gord Morrison, who's one of our advisors and was the former VP of exploration for FNX. So I'd say, came into this acquisition with a very good understanding of the geological controls. But it's amazing, after 100 years of mining at Levack Mine, and I'd say a lot of different eyeballs looking at it, we're still learning things. It's fascinating. And I think it's also very key to making new discoveries here. If we keep looking for the same thing we already found, we're probably not going to be as successful if we can look at things through a different lens and understand all of the potential controls. So what I'm showing here is the property boundary, which is our property boundary right here on this side, and then all of this, but stitched to a plate that represents what's called the Sudbury Brea, and that's the Sudbury Brea trend, this line right here. And it has the control in the footwall. It's the rock type that can host these high-grade copper footwall deposits. So we've done a job of sort of simplifying and modeling where that exists, because if you're going to find a footwall copper zone in the Sudbury North Range, it's going to be in this Sudbury Brea. So the first thing you have to understand is, where is the Sudbury Brea? Then you got to start looking at other things. Now, one of the things that we recognized is there is and we've always known, is there is a offset here called the Facunas fault. And this fault is a major fault, and it offsets everything at Levack Mine quite considerably. So it pulls apart the main contact zone. It would also move this breccia zone deeper into the footwall and further back. So that is a key sort of understanding when we're looking at what's there. Now, we've also have some knowledge of our neighbors, which include Vale and Glencore. And on this side of the property, Vale has been mining footwall mineralization for probably 30 years and are developed basically right up to our boundary. And just a few weeks ago, I was standing right here at Levack Mine that we came across on a drift from Coleman Mine, and there's a dam right about here that was put in place when Levack Mine went on care and maintenance from Inco, so you can't get right across to our number 2 shaft at this moment. But we came here and took a look at it from our side. So we've learned a lot about what's happening, and we're able to apply that knowledge to what's happening on our side of the Facunas fault, as well as what's happening down dip on our side of the property on the other side of the Facunas fault. So what is that? Well, this is the breccia. This is a section through the keel zone, through the Morrison deposit. It just kind of shows this blue is the breccia zone. So you can see it's not a straight line like I showed, but basically that line is something like this. But there's lots of breccia that isn't mineralized currently. Not to say that some of it couldn't be, but it's finding those traps and what controls those traps. So that's what our team has really been looking at. And some of those things are these granite plumes. We've modeled these that where these granite plumes exist, if you look straight down dip, you see veins that are in line with that. The Morrison deposit's a great example. And then it comes down when it hits sort of the center of this this Sudbury Brea, it changed direction, and then it seems to steepen up again. So what's controlling these changes, and is that why we're getting these big zones of massive chalcopyrite? So we noticed that there's another granite plume a few sort of 1,000 feet on trend from the Morrison deposit, and sure enough, a few historic FNX holes hit mineralization, and some of it pretty decent. 5.5 copper, 3.7 nickel with some PGMs over 7.3 meters. Almost no drilling in this area. So this to us presents a very interesting area, much like what we have here, to follow up and test this area. It looks like it's very close, but again, this is a couple 1,000 feet away. Up dip of that, we also have some other these granite plumes, and sure enough, we have the keel zone. So how is that related to these granite plumes? This area in here has seen almost no drilling whatsoever. So this entire Sudbury Brea area has potential for new big copper discoveries, very, very much underexplored even after 100 years. So this image right here in purple shows that same Sudbury Brea trend. Well, this yellow, that's those granite plumes across the property. And what we see is where you have Sudbury Brea, granite plumes, and then there's these bounding structures. And these are sort of northeast, southwest trending bounding structures that kind of contain the Morrison deposit. And when we mined it, we would actually follow these east-west sort of trending veins, and then we'd hit it, these northeast, southwest structures. The veins would take off in those directions. We would chase them for a while, but never chase them to their full extent, never really understood them. But now we see it's very coincidental that where we get this confluence of Sudbury Brea, these granite plumes, and this bounding structures, we get a big deposit. Where else do we have that? Well, we have another spot here, we have another spot here, another spot over here, and here, and here. So this is very interesting to us, as well as up in the keel zone, which is up here. So this gives us a lot more, I would say, exploration targets to review, and currently we're drilling one of these targets in an area where there's been a couple historic intersections of some pretty high-grade copper, but really no follow-up. But these intersections weren't, they were 100 meters away, sort of where we would target the potential areas to be. So we're really excited about this new learnings, and it just shows that even in a very, I'd say, well-mined mining property, still a lot of potential, a lot of things to learn, and a lot of ground to explore. Again, looking at this, so what does it really mean? Well, we see, again, a lot of potential high-grade copper here, high-grade copper up here, almost no drilling in this area, high-grade deposit found down here. Spin this around. KGHM drilled one hole from surface that tested this part of the Levack property at depth. And sure enough, they intersected 33% copper, 0.9 nickel, and almost 24 grams of platinum, palladium, gold over a very narrow intersection. But even at 20 centimeters, 6 inches, that tells us that there's a system down here that's carrying high-grade copper. This has about 400 meters, sort of east-west, and probably a depth before we get off our property on this Brea trend, there's about 5,000 feet. So big area to explore. Now, potentially one of the ways we could explore that later this year is, as I said, we were standing right here, potentially drilling from accessing through Coleman onto our property and being able to drill some of this off from underground. So that's something we think is a great potential, and we'll work on getting in place the agreement we need to do that, and hopefully start that later this year. but
So
very
Jason,
exciting.
this little skinny high grade that you found sounds like the Podolsky 2000 that FNX toured people through in February 2007. That was 87 feet of 26% copper, 2% nickel, and 1 ounce precious metals.
Yeah, it's the same, same potential style. Now, obviously, we want to find that big intersection, but this breccia unit, as you remember that section I just showed, you know, we show it as a flat plate here. It's actually a very complex, thick breccia unit. You do not find high-grade copper and precious metals like this in the footwall in isolation. You just don't. These are systems that will have, you know, big trunk veins and then these veinlets coming off of it. So once we have it, you know, we're able to then follow up on it. So really it just comes to drilling. The challenge KGHM had is they were trying to drill this from surface, which is very deep holes. And with an intersection like this, they didn't have the appetite to drill another deep hole. If we can get underground on the 3600 level and drill that off, we have, I think, a really good opportunity to define something. So yeah, it's a lot like that mineralization in an area that's untested.
Now, when FNX had extracted Podolsky 2,087 feet, and they kept drilling, they found other pods of material the same grade, but they were half bathroom size and not 87 feet across. So that the geometries are entirely variable.
Absolutely. At the Podolsky specifically, and again, this is one of the mines that we bought, and we really like it still. So it had the 2000 deposit, which was just a bulb, a large football sort of shape of massive sulfides, lead, mostly chalcopyrite, mostly copper. And then above that, they had a more vein-like, narrower zone called the Gray Gabbro zone. And then near surface, there's the 2000 zone, which again is more of a vein-like, sharp wall type system. Not the widths that you see in the 2000 zone. But again, these systems are not in isolation, and there's a reason they got there, and it would be through fluids moving, and there's obviously part of a bigger system. Again, on the Vale side, they've been mining a footwall zone called the 153, and early in my career, I was a supervisor for Inco in the 153 ore body, and it runs, you know, it's a very large system that kind of runs in this direction. They've mined it now up, well, they're developing now up in this area and drilling this area right here. This is actually Vale's deposit. It's called the number 4 ore body. And it was a very rich ore body mined by Inco before Levack Mine shut down. Now they've mined from Coleman Mine, which is about 2 kilometers away, all the way almost back to that. But that gives us a lot of insight. So when you look at the back of this, that number 4 zone touches this breccia. It comes right back. And then once it hits that, it allows copper mineralization and precious metal mineralization to flow through that breccia, that broken up rock unit. And that's how, you know, presumably that's how the 153 ore body that they're mining, you know, could have been fed from. This zone we're talking about in ours potentially could have been fed from. When we look at the other side of that, with this fault, it comes right back to what we call our number 3 ore body back in here. And in the footwall, again, it hits this breccia corridor. Where it hits that, we get some really high grade hits. You know, one of the ones that FNX drilled, 2.1 nickel, 12 copper, and 2 ounces of precious metals over 1.8 meters. Again, with that, I think it has almost an ounce of gold per ton. And you can see sort of on this angle, there's a number of these high grade copper PGM hits right here. And then we have on that same plane, our keel zone. And then we have great potential in between these 2 areas to continue to explore. So some of the drilling we're doing right now outside of this main zone, we'll be testing this area in between. Once we get underground with our drills, probably in the next quarter or 2, we'll be able to test some more of this area and kind of bring this up dip as we continue to define and hopefully extend the keel zone both up dip and down dip. So great area for exploration. And again, we have a lot of information knowing what was done across on the other side of the Facunis that we can then transfer over to understand on our side. And then I guess to wrap this whole area up on the exploration potential, the same breccia unit that hosts the 700 zone at McCreedy and the PM zone, that unit continues all the way and seems to have control over the bottom of the Morrison deposit where it breaks up a little bit. There's a bit of a gap here where the mineralization breaks up, the trunk veins kind of get thin and shifted, and then it seems to pick up again below that. This trend has seen very little exploration. KGHM drilled a few holes off this track drift, intersected some really high-grade copper, about 285 meters outside of the existing resource. It hasn't been followed up on yet. We were just looking at this yesterday for potential to follow up because it does seem that there's some of these high-grade copper veins that continue along this breccia corridor. So this is a very wide area in between two very long life mines that have significant footwall deposits that is very much underexplored. And this again is something we're looking at as recently as yesterday. So what can we do in this area that potentially could be accessed from McCreaty West, you know, if there's a discovery made in the short term and a mine plan put around it. So that's a lot of information, John, and I don't know if you have any questions, but I can kind of just talk a little bit then sort of our capital structure and what we've, the money we've raised, you know, more recently and sort of what our plans are.
So if you could explain the mechanics of the cash register and cash flow. Your first output in March that you'll report later this month with your March quarter. I guess you report revenue, but it books to accounts receivable. And Vale will wire you the money in early August after 5 months when they've refined the metal. Then your June quarter has 3 months of production and 3 months of accounts receivable with no incoming cash, increasing the accounts receivable to 4 months. Then the September quarter, when you report 3 months of production, you have 2 months of cash getting wired in from March and April with the 5 month lag. In your year-end financials that you report in February or March, we'll have the fourth quarter where you get wire transfers for 3 full months that are May, June, and July. So you report revenue, but it's not cash, it's accounts receivable. So your cash flow is negative in the March and June quarters. And you have a commercial bank accordion working capital financing? Is that how it works?
No, so what we've done is we've put in place a factoring arrangement with Desjardins Bank so that we can pre-sell our receivables, so we can sell them in advance to help that working capital balance. So we have the ability to use that. We've also went out and we completed a $33 million financing. We closed at the end of February to help, you know, with working capital and as well as some capital investment into McCreaty West for this year. So between our factoring facility to sell our receivables and then our, you know, our treasury and cash we raised, yeah, that's how we're going to manage our working capital for this year. But it is important in the structure of the deal. You know, we will only receive those payments for the ore that we produce. The ore that was produced previously will go to the previous owner, and so there was sort of a hard cutoff. But yeah, it's an important part and something we, you know, we looked at very closely and put these mitigations in place to ensure, you know, adequate working capital.
How much of a taste does Desjardins take or fee for factoring to give you the revenue months earlier?
Yeah, it's pretty relatively minor. So there is an interest rate on that for, depending on how quickly we do it. We could do it, in the month after we ship it, and get paid for it a few days later, get that advance or that payment a few days earlier, and then there'd be an interest rate charge on that for the other 4 months, let's say. So it's like short-term interest at, single-digit interest rates.
So they're charging you something that's at least 0.5% per month.
Well, it's per sort of monthly invoice. So once we have that number, that this is what we produced and sold, and this is what we're going to get paid, then we provide that to them and they advance it. And if the next month we decide we don't want to or we don't need to, we wouldn't. And then once that, we'll pay interest on it, let's say for 4 months on that 1 monthly invoice. And then after that, again, it's on a month-by-month basis. As of yet, we haven't done it yet, and because we have cash in the bank, and but we have that flexibility to do that if necessary.
Once again, questions are welcome from the question box. There's a question about the western side of the 700 zone that you're drilling now. Is that infill drilling of the existing resource or exploration drilling to extend it?
So some of the drilling we're doing is extending it. Some of it is following up on old Inco drilling. Once we get our development out, probably within about 2 months' time, we'll be out past the old mining with our development, and then we'll have drill platforms to drill completely outside the resource, and that's where we want to get to. So some of what we're doing right now is sort of not ideal angles, trying to get out to that west side, but it's a mix at the moment. But within a couple months, it'll be drilling outside the resource.
As you allocate capital, is working capital financing or repaying off the factoring the lowest priority, or exploration spending to define new ores, higher grade ores, and then development to restart Levack and the other mines and increase McCreaty West to the higher priorities?
So I guess on the factoring, the way it works is we have a receivable for the previous month, let's say. We sell it to them and they are actually going to receive that. So it's not, we're going to pay it back. We'll have that, cash that we'll receive from Desjardins minus an interest payment. So that there's not like we have to repay that. I guess to answer your question, I think what you're trying to ask is exploration is very important to us. Again, we have a team right now looking at all of our other properties, Podolsky, Kirkwood, which is a great exploration property I haven't talked about at all. FNX property, one they never really got to, but has a few high grade hits in it that haven't been followed up on. Our Crean Hill property, which we did a lot of drilling on last year, and we think we have some very interesting targets to follow up on there. Our Shakespeare, where we made a copper discovery last fall. So all of this is very interesting to us, as well as, of course, Levack and McCreedy, stuff that potentially any discovery could be put into a production fairly quickly. So, we will do that sort of analysis of what does the rest of the year look like, and we're working on that right now. And in some of these cases, some of these properties, there is the opportunity to use CEE, so the Canadian Eligible Exploration Expenditures, which provides a premium to sort of hard dollars, and is a more cost-effective way to do exploration. So, it's potentially, we may even raise a little bit of cash sometime later in the year to do some of that exploration away from the mine sites. But it is something I am always, pushing for of our team to say, let's make sure we're doing that, because I know from experience, these discoveries can make a huge impact on our cost of capital and on our, our mine plans and our life of mine. So I am a big advocate of exploration and will continue to have, many drills turning. Right now we have 5, but I wouldn't rule out having more later in the year.
So your business plan, if you would be highly fluid, where each month's exploration results update and inform priorities for engineering, capital allocation, and business planning.
Yeah, I don't know if it would be quite on a monthly basis, but definitely as we drill and we get new information, that is going to get incorporated into our block models, which may, change our mine plan for the following quarter slightly. And as far as exploration, we do like to sort of put it in 6-month blocks. So we had an idea what we're going to do for the first half of this year. As we get new information, and if and when we make a discovery, obviously that changes things again. We'll probably get very focused and get more drills to delineate whatever we discover. So yeah, we can move fairly quickly, but we like to have at least a 6-month plan that we kind of execute, and subject to drill success, that might change.
So the KGHM, the Polish copper company, bought out Quadra 10-14 years ago.
Mm-hmm.
And they have 400,000 tons of copper output plus silver in Poland. And the Robinson mine in Nevada, the Sierra Gorda in Chile, and then these mines in Ontario. So if Sudbury got 5 or 10% of the senior management time, it was lucky. How many of your projects essentially got no attention and were neglected the decade plus that KGHM owned them?
Well, again, this is my opinion. This is not fact, and I wasn't part of the company, so I can't speak to it, directly. But Levack Mine was, at the time that Quadra FNX was acquired, was, I would say, a strong producer, producing reasonably significant amount of copper and byproducts. It is a mine that you need to continue to invest capital, and I think that as a much larger company, KGHM had other places to invest capital and pay attention. So over time, there was less and less attention paid to these assets in Sudbury, and that's typical of large companies with assets that are eventually deemed non-core. They do just receive less attention, less capital, and that makes it very tough. We're in mining's an industry that requires capital investment, and when we stop investing capital, whether it's in operating capital, equipment, capital exploration, you start to almost, so to speak, paint yourself into a corner where then you have to make some really tough decisions. So I think that there was probably a number of years that KGHM realized these assets in Sudbury were non-core. It took a while to get a process in place and then get it closed and us to take over. But that's the opportunity we saw long ago when I founded Magna, for these majors in Sudbury that have non-core assets that are not paying enough attention to them, or they just don't fit with their structure and their goals. For a company like Magna to come in, and we know how to operate these, and we operate differently because of the size of the company and the culture. So that's the opportunity. But yeah, I would say they all received a lot less attention than they deserved and than they needed.
Well, congratulations. You've got a much bigger property portfolio than a year ago, and probably 1 or 2 more years from now, it'll be even bigger. Thank you very much for your presentation and for your service to the shareholders.
Well, thank you very much, John. It was a pleasure.
Thank you.
Great.